Welcome to the Three Questions webcast series. I'm Wayne Baxter, Senior Executive Manager with One Capital Management. At One Capital Management, we develop and implement strategies for our clients that strive to grow, protect, and ultimately distribute their wealth. And we do that by offering investment wealth management services. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions webcast series, please consider liking this video and subscribing to our YouTube channel. Now, our process for advising cross-border clients includes an in-depth discovery and diagnostic analysis of their wealth management goals and objectives. And needless to say, that will include an in-depth review of their investment strategy. One Capital clients, whether they reside in the United States or Canada, benefit from an ongoing oversight of their portfolios. They have a dedicated portfolio manager who oversees the day-to-day trading activity of their investments. There's also weekly review meetings that are held by One Capital Management's investment committee. And during these meetings, there is a market overview that takes place with discussion and review of global markets, U.S. markets, Europe, Asia, emerging markets, and also a look at the geopolitical landscape. And on top of that, there's a portfolio review that's conducted at the level of geographic allocation, size or market cap allocation, other asset classes, individual security selection, risk management, tax loss harvesting strategy, and rebalancing tactics. So it's a very in-depth process. Now, ESG, or environmental, social, and governance investment, began gaining significant momentum during the latter half of the last decade. The roots of ESG investing can be traced all the way back to the 1960s and 70s, during which time socially responsible investing began to emerge. Today, we're going to explore ESG investing on a more in-depth basis, and we hope you enjoy it. Stay tuned. On this webcast, we're reviewing the 3 questions cross-border investors should ask about ESG investments. Joining me is Steve Cowley, Chief Investment Officer here at One Capital Management. He is the Chairman of One Capital's Investment Committee. He's also a chartered financial analyst, and Stephen is a member of the Los Angeles Society of Financial Analysts. First of all, just thank you for making time to join us. I've been wanting to have you on the webcast for quite a while, and I think we have a good platform to get you introduced to the webcast, and we'll see if we can make it exciting and interesting, and try to educate and inform at the same time. I really appreciate you making time.
Thanks for inviting me. I'm looking forward to this. We have great discussions in the office.
You took the words out of my mouth. I was just going to say one of my guilty pleasures of being here at One Capital is taking a walk down the hall to the trading floor and looking through the window and seeing if Steve's off his telephone or not on a Zoom call, and if he is, I'll sneak in for a 2-minute conversation that usually lasts about 45 minutes. Usually, we're
yeah, your 2 minutes usually lasts about 10 to 20 minutes, so
or longer. And usually, by the time I walk out the door, Steve and I have basically figured out how to solve all the problems of the world.
And of course, nobody listens to us. But solutions.
Story of my life. What can I tell you? Okay, you know what? Before we get to our questions, I'm really interested. The investment committee meets, like I said, on a weekly basis. You're doing all this discussion, on such a broad range of topics. What I'm really interested to know now, because I can't imagine you're not talking about it, is the investment committee's views related to real estate investing. The fallout from the Fed raising interest rates by 5% here over a relatively short period of time. That's on the short side, on the short interest rates. There's a lot of talk now, as most recent as today, talking to a commercial real estate professional up in the Bay Area, in San Francisco, about the vacancy rates across the United States. We're hearing more about owners, and again, up in the Bay Area, walking away from commercial properties, putting the proverbial keys on the counter, lenders taking write-downs. I can't imagine that this is not a part of your discussion, and given the fact that we do, obviously invest in real estate investments. So interested in what your thoughts and the committee's thoughts about how this is going to unfold and how investors are going to be impacted.
Well, actually, it's a great question. We do talk about it all the time. But one of the things to remember is real estate is very broad. And the headlines that we talk about and the the scare tactics, and I mean that's what gets people to pay attention to the news and everything else. So they talk about real estate, they talk about. But when you break down the component parts of real estate, there's a lot that are doing well, there's a lot that are recovering, and there's a sliver, a segment that's actually really struggling. And we actually we think that's going to continue to struggle. And that's really, it's urban centers. It is office space, office building, because we've had just a tremendous change from work from home, remote. People have said, hey, I don't need to go to the office as often. And so there's going to be there's a shrinkage, and there's a tremendous amount of vacancy rates in the big cities, and most of them are ranging
like 30% capacity now, Steve. I keep hearing over and over, and not just here in LA, but all the other big centers as well, like Chicago, New York, for sure, obviously.
So all of them, like I said, some are 27%, some are 35%. So some are around that 30% range for office space. So that component, that piece of real estate is struggling. It will continue to struggle. Now, again, it's where most investors worry about it, and the media worries about it, is big banks.
Yes.
Because, most real estate is actually owned individually, whether it's in, the mom and pop that owns an apartment or a building, and they lease it out and things like that. But the big banks, of course, they lend on. As a matter of fact, you mentioned the Hilton Group that's talking about pulling out of San Francisco and literally walking away from 2 hotels that they own there, with a $750 million loan on it. So the banks would be the ones that would be hit by that. And interesting that you would bring this topic up today, because just today, the Fed released their latest stress test on the major banks.
I just saw that literally just a few minutes ago, honestly.
And one of the stress items that they said is commercial real estate falling 40% in value and how it would affect them. And they all came through with glowing colors. So it's a problem. It will be a problem. It'll be a headline problem. You'll see bankruptcies. You'll see people walking away from that space. And then the other thing is it's not getting as much press, but it is on the peripheral, and that is, the urban decay that's taken place because of pandemic, because of policies. Here in Los Angeles, we have a DA that has decided not to prosecute, and it's pushed some issues down. Well, it's caused crime to go up. There's, as a matter of fact, there's a law just proposed here in California yesterday that is to prevent people from ever confronting a shoplifter. Why you would pass a law that says you can't confront a shoplifter, I don't know. But again, I'm going to leave the politics aside, but that's opened up a lot of theft. And in San Francisco, you mentioned it is one of the areas that is really, a hot topic, because people are walking in, they're stealing, and a number of stores have closed. And one of the city council members up there, instead of addressing the problem, suggested that they raise the mall, just tear it down and do something else with the real estate. Now, again, that's not a solution to a problem that they're having. But so that's where you're getting this anxiety about real estate and those things. Now you go to you go a little bit outside of that, and you get to the smaller real estate. Housing, especially multifamily housing, is booming, and we have a shortage of housing. So those
which is also considered commercial real estate to be,
exactly.
If you have more than a property, 4 units or more, is considered a piece of commercial real estate, just in the context of.
Piece of the real estate is doing really well.
Yeah.
You go to the strip malls, and because we're coming out of the pandemic, restaurants are starting to open up again. Stores are starting to come back. There's starting to be more and more of that. So it's kind of a mixed bag, and that's why I say real estate's so broad that you have to kind of narrow it down. And there's problems, but it's in a relatively small segment of real estate. It wasn't that long ago we were talking about malls being shut down because the stores were closing. Everybody's going to shop online. Go to a mall today, after the pandemic and the pent-up demand and not being able to get out, they're packed. Stores are starting to come back into the malls. So the mall is not dead. The mall is actually starting to come back. So to make a long discussion shorter, real estate's not nearly as bad as people think. There are segments that are struggling. There are segments that are doing really well. Part of our investment committee is trying to identify where that is and take advantage of it. So we own real estate investment trusts in the portfolios.
Mm-hmm.
It's a broad, diversified portfolio. It has all of the different segments. We're always looking inside of those ETFs and saying, is the segment too large in commercial office space? And if it is, we'll find something that does a little better. But right now, we're very comfortable with what we own. Another big component of real estate investing, especially for the portfolios we have, is the cash flow. And with interest rates going up, you're also having rents go up, you're having a whole bunch of things. And so the cash flow should start increasing as well. They've struggled because interest rates have gone up. That means the cash flow that they were getting is less valuable than it was before. Believe me, the real estate market has had such a huge run that people got a little bit too passive on their investing in real estate. And so that's correcting itself right now. Valuations are changing. We're starting to get yields back to where they should be. So while real estate hasn't been a great performer in the portfolios, we think over the next few years, it'll turn and it'll be a viable, again, another very valuable component of the portfolio. And one of the things that we preach and you've mentioned is diversification.
Good segue. I guess before I guess one of the things that I guess I would say is, so in your view, the current allocation, which is a typical balanced portfolio, we probably allocate about 3% to the portfolio. You don't see that significantly changing in the next, you don't see that having to be adjusted downward. You're comfortable with that right now?
I think the opposite will happen. I think the adjustment will go upward.
Interesting. Okay,
So
there you go.
We were running between 5 and 7%. We took it down because the cap rates were going down, the yields were coming down. The risk reward wasn't quite as good. Now, there was a appreciation component that I don't want to say we missed it, but it kind of kept those real estate investments doing better than we had expected for a little bit longer than we had expected. But with interest rates rising and everything else, we were already lighter in our portfolios in real estate than we would typically be. Typically, like I said, we're 3 to 5% is a normal range. We're at that 3% level. We could get as high as 7%, something like that. So we're kind of at the lower end level. I would expect in the next, and again, don't hold me to this because things change from time to time, but our next move is probably up in allocation, not down.
Well, that's really interesting. So I guess we shouldn't be standing waiting and having a replay of 2008, 2009 commercial real estate version in the short term. That's what I'm hearing. Okay.
And well, again, different components going in. Housing's not the problem that it was 2008, 2009. Like I said, 2008, 2009 was a much broader. It was, housing.
Oh yeah, no.
As well as
we had a bigger systemic issue, exactly. Most questionably.
This one we really targeted in a narrow band.
Well, this is really a reminder of, to me, 5 basic principles that when it comes to investing, this is something we live by, and that is, it's the portfolio's overall result that matters, not the results of its components. And sometimes people get caught up too much on specific components of their portfolio. And really, the less correlated the returns are, if the component parts, the better. So in other words, you don't want to have everything going up at the same time, because that's really a harbinger of having bad things to come, right? And number 3 is effective diversification means that not every investment they aren't going to all work or fail at the same time, right? They're going to have some things doing well, something not doing well, and then you're going to see things change because the markets are cyclical, right? Systematic portfolio rebalancing, something that I've been adhering to now for 20 some odd years, is going to add to your return while reducing risk, or rebalancing back to your stated allocation, because capital markets tend to revert back to the mean, right? And if you have a taxable account, like here in the United States, a trust, or a non-registered account in Canada, tax management adds significantly to all, to after-tax returns. So the idea of what we call tax loss harvesting really works. So if you adhere to those 5 basic principles, you should be okay. Okay, so we've covered that, I think. Great job, Steve. Thank you for that. So let's get to the 3 questions cross-border investors should ask about ESG investments. And I think, Steve, the best place to start here, really, because I'm sure not everybody is focused on this as and we are, and that is, what is ESG and what's driving the interest in it?
So ESG is, what it stands for is environmental, social, and governance. And so it's 3 letters that encompass three different pieces of how a company were to manage their business. One, how are they handling the environmental impact of what they're doing? What is their social impact within society? And the last is governance, and how are they doing relative to the laws? And on the governance, it's not necessarily just regulatory and stuff like that, but it's, you know, how are they governing the company? Who's overseeing? What does the board look like? What does the board makeup look like? So governance, while it sounds like it's just following the rules and things like that, it also includes diversity within the board within the company. How many women are on the board of directors? How many people of different ethnicities are on the board of directors? So that's actually part of the governance side. It's almost diversity as well as it is governance. And then of course it's the regulatory, and you know, how are they treating you know, their responsibilities to people. So ESG is it's kind of become it's like everything, you know, you get a title and it's huge and it's all encompassing a whole bunch of things. And so the reason that ESG has really kind of taken hold is because we all want to feel good about what we're doing. We want to feel like we're making a difference. And, you know, the world is so big and there's so many things that are happening out there, is, you know, how can I do my part to feel better? So now here's where I'm going to be a little bit disparaging on the ESG industry. These guys are really smart. So what did they do? The marketing geniuses came up and said, hey, let's brand this and market it as, you know, environmental. We're good to the environment. We're wonderful for the social structure of the company, and our governance and our diversity is just a wonderful thing. So again, that's my little bit disparaging remark about that, because a lot of this is driven by those marketing people. But the notion behind it is a company, are they treating the environment the proper way? That's the environmental side of it. Are they making a positive impact on the society as a whole? And are they living up to their governance and what they should be doing and running the company? And are they including all of those run and including the entire sector? Now, a few years back, there was an article, a big full-page ad in the Wall Street Journal. A whole bunch of CEOs signed a statement that they were going to follow this wonderful thing, and it was ESG notion, but it was the notion of stakeholder capitalism. And it's, you know, we recognize that our clients, you know, our customers are really important, and we recognize that our employees are really important, and we recognize that the environment is really important, and they all sign their name to it. And just as a side note, what I said to my wife that day is, I said, every one of those people should be fired, because if they didn't know that to begin with, then they should never have been a CEO in the first place. If you're going
so you're saying that they're being accused of a bit of virtue signaling here, just a tad.
A little bit. And again, the notion is really good. The notion is, you know, it's you should be paying attention to your environmental impact. You should be paying attention to how you do. But again, they should have been doing that in the first place. So if they weren't doing it and they had to sign their name to signal that they were, you know, these wonderful people, my comment was, is if you have to tell people that you're doing that, then you haven't been doing it and you're just sending a signal. Because if you're going to run a business, your customer better be happy with the product you're providing, or they're going someplace else. That's the beauty of capitalism. You have to earn their trust every day with your product. If they're not taking care of their employees, they walk to the competitor. Guess what? We have a great mobile workforce. You can go find another job. And if you weren't taking care of the environment and you're polluting it, guess what? The EPA is going to come down you. Your neighbors are going to notice it. The newspapers are going to notice it. You're going to be in trouble in a real hurry if you're damaging the environment that way. So that's why I said, when I saw that, I was actually very disappointed that they felt like they had to do that. Again, probably the marketing departments got a hold of them and said, hey, let's do this and it'll look really good for our companies. So the notion behind it, we're all for it.
Okay, so from your point of view, okay, so basically the premises are 100%, nobody can dispute them.
Right.
So, okay, so that leads us to the next obvious question, is what are the challenges that you see it as a portfolio manager, literally managing billions of dollars of people's life savings? And what are, in your view, in your experience, and you're looking at One Capital's investment committee's perspective, what are the challenges I guess you could say related to focusing on ESG investing as a sort of an underlying overall strategy.
And using that title as an ESG title and exactly what you're saying.
Yeah.
Probably the number one biggest is who rates ESG? Who's the one that tells me that an ESG score is good or bad or indifferent or something like that?
Maybe you could explain a little bit about the scoring system too, just as a part of that, because you brought the score up. So I mean, to folks, people would probably be helpful to explain that there is actually some kind of a scoring system that determines whether.
So here's the other thing that's a little bit of a rub on the ESG industry is the scoring is actually done by the companies. They report what they're actually doing. There's nobody in there that's actually auditing and saying, are you actually doing what you say you're doing? So there's a report that the companies fill out that identifies what they're doing. What does their board makeup look like? What are they doing on the environmental? What are the roles they're taking? Which again, I'm not knocking the companies because they're honest. I think they're reporting exactly what they're trying to do. They're trying to get a good score. So they're reporting it. So that's a challenge if the company itself is reporting. But then the bigger challenge is the people who compile those data and then assign a score. And again, it's just a score, it's just a number. And so you have to use it relative to one another. So a good company might score 65 and a bad company might score 50. But who determines what that good is? So the companies that put those scores together and give you a number, there's a whole bunch of them out there. And so which scoring system and company do you adhere to and say, oh, these are the guys that I want to follow? Is it MSCI? Is it analytics? Is it ESG risk? Is it Bloomberg? Is it Moody's? Is it S&P? Who's doing that? And when we looked into this and we did a lot of research on it, depending on who you were and how they scored it, some were relative score. So ExxonMobil, you might think that oil is a really bad thing for the environment, and we'll get into that in a second. You may think that's a really bad thing and Exxon might score right up there with Microsoft on their environmental, not because they were good, but because they're the best of the oils. It was a relative score. So Chevron might score lower and somebody else might score lower than that. But because ExxonMobil was the highest scoring environmental company, it then scored really high. So that was a relative scoring basis. There's another company that looks at it, and instead of doing it relative, they kind of just assign this industry is this industry is that. So you get discounted or given a premium based on what industry you're in. Now, that again isn't a true method of scoring. So that's probably one of the hardest things to do is look at the scoring. Now, again, that's not to discount it. That's not to say that it's not needed, and you can't look at relatives and you can't look at multiple company and multiple scoring methodologies and get a pretty good feel for it. So, but that's a tough thing. The other thing is when you think about it, and you just intuitively think that, oh, I want a good score. I want a company that's doing really well on these three sectors. 88% of public companies have a whole department that's all they do. They work on the environmental, social, and governance side of things. So 88% of public companies are already doing that. 79% of private equity and venture capital companies do that. And 67% of private companies that don't have any oversight by people are really working on getting better at all of those things. So now you're talking about, it then becomes a judgment. So that's the next thing is, who determines what's good and bad? Who determines if it's a good company or a bad company based on an ESG score or based on a, so I brought up ExxonMobil as a great example because ExxonMobil is an oil company. They produce oil and gas, they drill for it, they refine it, and they produce it. Now, some people may say, because of the environmental and all the discussions, that that's a really bad thing because they're polluting the environment with CO2 and all of those things.
Expanding the carbon footprint.
Exactly. But what you don't realize is ExxonMobil is the largest single carbon capture company in the world. So they're capturing carbon and putting it back into the earth. So they're working on reducing their carbon footprint and actually taking carbon dioxide out of the air. Now, again, we could have a whole discussion on the environment. We probably should do 3 questions on that one later on. So the question then becomes: are they good? Are they bad? And then it becomes a judgmental thing. So then it becomes, again, this is where it gets difficult. And this is where the marketing department will come out and will say, we're going to do an ESG fund and we're going to label it as such. Now, about a year ago, Deutsche Bank got into trouble because they labeled stuff ESG. They were really pushing it. They were selling it to the public, and there was no ESG component. So there was no scoring. There was no comparison. It was basically the exact same as their other funds. They just slapped a label on it. So these are the things that get difficult when you're working in the ESG world. So when you look for a fund, you look for an investment, you say, oh, I'm going to do an ESG ETF or a socially responsible ETF or something like that. It's hard to know if it's more marketing or if it's actually true. So we try and look underneath that. The other thing that runs into problem there is somebody else is telling you what's good and bad, because ESG is not good or bad. It's just, how is is the company addressing the issue? Yes, no, and what are they doing? And it creates a score. So that doesn't mean they're good or bad. ExxonMobil, it's not a judgment that they score one score. It's just, what are they doing on the environmental side? And they have it a little bit tougher because they are an oil producer. Mm-hmm. What are they doing on the social side? And they're very active in that. What are they doing on the governance? But when you go to one of these rating agencies or a group that's telling you something, in the UNPRI, there's a whole UN policy for responsible investing that they're pushing. Somebody is telling you good and bad. But that's not what ESG was about. ESG is about ranking and scoring and saying, are you making a positive impact towards these things or not? But part of the marketing is, and what you're seeing out there a lot is people are saying, oh, I'm ESG because I want to feel good and I'm doing something good for the environment. Well, that's not necessarily what ESG was really meant for. And so when somebody, again, I brought up the UNPRI because in our industry, companies like ours are asked to sign a pledge to the UNPRI. And we've decided not to sign it, not because we disagree, like I said, with the principles behind it, but because it's somebody else telling us what to think, what to do, how to view these things. And so those are the problems with ESG and investing is you got to look underneath it, make sure it's real. And then if you do it in a fund structure, it's somebody else is making a decision, what's good, bad, what's a good ESG, what's a bad ESG. And so it's not that we don't take those into account. And I think your next question will probably talk about some of these things. But so as you can see, there's a lot of gray area in ESG. It's not just, oh, this is a good thing, let's buy it, and I'm going to feel good about myself.
Well, Steve, what you just basically did is just reaffirmed my comment about knocking on your door and coming in and sitting down for 2 minutes. Yeah, it was, our conversations usually don't last about 3, that's for sure. And you did a great overview and explanation of the challenges. And again, yeah, the obvious third question, question 1, what is it, ESG? And 2, what are the challenges with investing in ESG investments? So I think the fair third question is, how does One Capital as a portfolio manager approach ESG investing? And I'll say right off the top here, we're not a mutual fund per se. One Capital clients own individual, stocks, bonds. They own exchange traded funds, to give some portfolio completion and diversification. But, there's not a One Capital fund per se here, as much as there's a One Capital portfolio. So I guess the question is, how do you approach this issue within the context of a client looking at their statement and those who want to make sure that they're being a responsible investor? How do you sort of satisfy that concern?
Yeah. So a couple of things that we've done and we continue to do. So one, our philosophy is that, again, like I said, there's nothing wrong with the words environmental, social, and governance, and the principles behind those. And so we take those into account. So when we're looking at companies in our analytics, when our analysts are looking at those things, those are factors within our decision process. Because obviously we don't want to buy a company that's polluting the environment, that's egregiously, because it's going to come back and bite it. It's just bad business policy to do that. So we're going to look at all of these components. We're going to look at the environmental and what they're doing and how they're doing it. It's not going to be our number one driver. We're going to look at their social footprint and what they're doing and how they're addressing issues. It's not going to be our number one driver. We're going to look at their governance and, are they doing things the right way? One of the problems I have with governance and with quota systems, which is kind of what's happened with this quota, is you start losing qualified people just to fill seats. And it's not a knock on women. It's not a knock on anything like that. It's just when you have a board and you have so many boards out there, there are only so many qualified people. Unfortunately, we just haven't built up enough qualified people in some of the areas. And so all of a sudden you have to compromise and you have to, say, okay, we're going to just fill the seat with somebody because we have to meet this quota of what it is. That's a problem. So again, not that that's not important, because you want those views, you want that out there, but you got to be careful that you're not just filling a seat just to put a number and say check on a box that on my ESG score it's all of a sudden better because now I have 40% women on my board versus 10% women. Again, that's not a knock on women. The more we get in there, the better, because they have a very, very valuable voice. They see things different than men do, and they're concerned about things differently. So again, it's a tremendous asset to have on the board, but you don't want them doing it just to fill a seat to check off a box. You want it to be qualified people that help out. So we look at all those things, but again, they're not our number one driver. We're still looking at, how's the company, what are they doing, how are the profitability, where they're going, because again, if you can't satisfy your customer and you don't have a good product, it doesn't matter any of those other things, they're not going to matter. You've got to have something that people want, that they're going to buy, and you've got to make sure that you take care of your customer and you're selling them something that they want, that they need, that they're, that will make their lives better, that will entertain them, that will do all of those things. So those are the drivers. So we take those into account. The other thing that we do on ours, and just as a side note on that, we actually scored ourselves a few years back on the ESG scoring method, and would we hit those high levels of ESG? And what we found in our portfolio is we had 2 stocks that knocked our score down. Everything else was super high on the ESG score. And again, this is one of the crazy. One of them was a Chinese company that we've since sold, and the other one was actually Pfizer, of all things. And Pfizer scored really low on one of those 3 components, and so it knocked their score way down again on a relative basis because they weren't quite as good as Merck or Lilly or somebody else. So they had this really low score that pushed their score down, but the company itself was really good. And it wasn't that they were bad, it's just they weren't as good as somebody else. And so again, on that relative scoring, it can really hurt you. So our portfolios are really, they're well diversified, and they have high score. But like I said, 88% of public companies already have a very active presence in this.
Especially S&P 500 companies are all pretty much ESG compliant.
Exactly. Now, again, because of the scoring, one of them might get knocked down and it might not be a bad company. So the other thing that we do, and this is one of the conversations we've had in our 5-minute chats, right, is I would rather that the client tell me what's important to them than somebody tell the client what's important to them. So I don't want to do an ESG investing just to do an ESG investing so that and I say feel good. Again, we all want to feel good about what we're doing. So that's not a bad thing. But you don't want to have an ESG just to have an ESG because somebody else is telling you what's good and what's bad, what scores well, what doesn't. I'd rather the client tell us what's important to them, and then we'll manage the portfolio around them. If they don't want, oil and gas, we'll have that discussion. And if that's a real driving factor for them, then we can build their portfolio with or without those things. If they don't want to have tobacco and firearms, which we don't have in the portfolio, but if they don't want to have it, let's have that discussion. Let's have a discussion of what you're passionate about, what you want to invest in or avoid investing in, and we'll build a portfolio around that. There's plenty of opportunities and there's plenty of investment opportunities around that. Now, again, we'll have the discussion, because if somebody came in and says, I don't want to own oil or gas because they're a very pollutant company, we'll have a discussion about why you might want to own some oil and gas in your portfolio. And then, like I said, you get to decide whether it's, if it's one of your passions or not. So I'd rather invest for your passion than for somebody else telling you what your passion should be. So that's how we do it here at One Capital.
All right. So I guess the call to action here, in terms of, and great answer, Steve. Thanks again, and very insightful conversation here today. But a bit of a call to action here on a great way of developing a portfolio. There's some basic principles again. We talked about, the way portfolio strategies work, but just, how do you determine how your portfolio should be allocated? There's some basic rules. And I think the way we should start the discussion from the very beginning, like from the ground up, is to do the analytics, the cash flow and the analytics, the capital forecasting. You know what that's going to do is that's going to help determine the spending rates or the yield that the portfolio needs to have in order to be successful. So that's where we really start. Then we can get into making sure that your stock and bond portfolio is allocated according to that, right? Number 3 is have a plan and stick to it. It should only change if your circumstances change. So, instead of being driven by outside forces. So really, that's the key. Do the planning, do the analytics, develop a strategy that addresses what you want your portfolio to do, and then change it only if your circumstances change. Steve, before we wrap up, some final thoughts from you. Anything you want to just wrap up with here before we sign off on this episode?
I just said that, the discussion we've had about ESG is really important, because but what you just said, having the discussion and the more information that is given to the advisor, to Wayne, to us, and your passions and stuff, that actually makes our job on the investment side much easier. We have a pretty good idea of what we're doing. We're pretty good at what we do. But what matters to us is the client being able to sleep at night. And so all the things you just said, Wayne, if you've got the cash flow analysis and you understand what's going on, and you've identified your passions and what drives you and what's important to you, and then you have that plan in place, our job becomes really easy. And the beauty of it is the client gets to sleep at it. They don't have to worry about things, because like I said, so it's great. So you couldn't have said it better, Wayne. I'm reiterating exactly what you said, and this has been a lot of fun.
I really appreciate it. Steve Cowley is the Chief Investment Officer here at One Capital Management. Did a great job with us. First time around, we're going to have him back again. Steve Cowley, thanks a lot.
All right, thank you.
I look forward to bringing you the 3 Questions webcast series, and I hope you find them educational and informative. Please consider liking this video and subscribing to our YouTube channel. And to receive a notification of when our latest webcasts have been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we'll see you soon.